All right? Okay, so going back to when did you determine, you know, any one of us here, I'm assuming most of us here in the room are probably pretty familiar with what goes on the fiber, the euro-US dollar, on a regular basis. So at what point did you say this market was heading down? Well, for those of you that are familiar with clock angle readings, okay, and have heard me talk about them, here's the easiest way to look at what I'm saying here. So I'm going to go ahead and draw kind of a mock clock here. Imagine this to be your 12 and 6 o'clock, okay? And then I'm going to go ahead and draw a little segment here, and that'll be 3. Make that one as red as well. Okay, so imagine this to be 12, 3, and 6 o'clock. We're in our market memory, and I kind of look at the angle of the wave as if it was the hands of a clock. Okay, and if you notice, if you were to read this right now, and I like clock angles because we all, I don't care where you are in the world, we all seem to have a very common understanding of what an angle 2 o'clock means. You know, heck, we all seem to know it so well. They make watches without numbers on them because we know these angles so well. So if I tell you 4 o'clock, if you know how to tell time, and I'm assuming most of us do by the time we graduate first grade, second grade, I don't know when they teach it, but we've known since we were children. If I were to say 4 o'clock, we have a pretty good understanding of what that angle means. Okay, I don't like using degrees because none of us are human protractors. At least I'm not. But I think the familiarity with 12, 1, 2, 3, 4, 5, 6 is such that even without this 12, 3, and 6 for comparison, most of us could look at this and go, wow, if that was a clock, I'd say that's pointing at 5 o'clock. Would you all agree? Now remember, if you are looking at this outside the market memory, hopefully now you'll see that if you are not looking at it within a 1 to 2 week look back, you could actually change the angle of this direction of the wave. So that's why it's so important to take that, what I call a clock angle reading, within this view, the look back view. Okay? So this is how you basically begin. So just imagine this angle is 12 o'clock, 3 o'clock, and 6 o'clock. I just have them for, for comparison's sake. Okay? And like I said, I don't even think we really even need it, but if you would imagine these 3 lines moving down, what time are they pointing at? Okay? 12 meaning, up, 3 here, and 6 here. Don't overcomplicate this. Okay? What angle is this? 5 o'clock. Does everyone agree with me? It's certainly not 6. I don't think it's shallow enough for 4. This would be 5 o'clock. Now, when can we determine that this market started moving at 5 o'clock? If I just go a little bit at a time from the right edge, when can we say this started moving at 5 o'clock? Or actually, a downtrend, a markdown cycle, is 4 to 6. So really, you're not looking specifically for 5. You're looking for this angle that we could call 4 to 6 o'clock. So when did this thing started moving at 4 to 6 o'clock? And there's no right or wrong here. I think that basically, as I move it over, just kind of look at the price actions. I'm moving it over, and kind of decide for yourself when you felt the prices are moving basically between 4 and 6 o'clock. And I'm assuming that most of you are going to say so right around this area here, as prices were trading around the 37.30-ish area, and as they started moving down towards 37.10. Okay? I'd say mostly around there. I'd say most of you probably are saying, yeah, that's 4 to 6. Most definitely by now, right? That's when we took a sharp angle towards 5, and that's when we took that really sharp dip below 3,700, and I'd say it was pretty obvious by then. But do you see the value in being able to make that assessment a little further up the price chart here, a little further up our price axis, making that determination that before the sharp rally and the sharp sell-off, and everybody knows it, there's a huge advantage to be able to determine that the sentiment is down. How do I know the sentiment is down? Well, for one, prices are trading below the wave. And you'll notice that I use a plugin here that I'm not sure when it's going to be available, but I know it's in the works. This plugin is called Grab, G-R-A-B, green, red, and blue. And what it does is it plots my candles in green if the close is above the top of the wave, the 34 EMA high. It plots the candles as blue if they close within the wave, in other words, within the 34 high to 34 low. And it plots the candles as red if prices plot below the 34 low. And you'll notice that even before we can say that the angle was sharply 5 o'clock or even 4 to 6, we started pricing on what I call the weak side of the wave. We started plotting the candles in red. Prices are below the 34 EMA low. And while it may not be clearly a 4 to 6 o'clock downtrend, markdown cycle yet, there's definitely a sentiment shift that things are a little bit weaker. Does everybody follow me so far? Okay, so do you need the grab, by the way? You absolutely don't, because the 3 lines of the wave, which is the main part of this discussion we're having, can absolutely be loaded up just by going into insert indicators and putting in the 3 moving averages. So please remember that. You don't need grab, although I do love the visual that it gives us. You don't need it. You just need the 3 moving averages of the wave. Okay? So we've talked about the wave, we've talked about market look back, we've talked about the angle here and how to take the angle. There's basically 4 angles you need to be familiar with. We just talked about the 4 to 6 o'clock. That's a downtrend. What about an uptrend? Let's slide this back here. This angle right here was when the market was heading up higher. And this cycle would be called a markup or an uptrend. And we assess this from, again, within the wave, from using the wave from within the market look back. That on this chart here, the 30-minute, that 1 to 2 week look back or market memory. The angle that we're looking for an uptrend is 12 to 2. So when the market's moving up higher, 12 to 2, that's a markup. It could be very sharply higher, again, kind of edging towards 12. It could be a little bit shallower, edging towards 2, but it's 12 to 2. That's an uptrend, like what you see right here. Okay? So a mark down or a downtrend is 4 to 6. A mark up or an uptrend is 12 to 2. And again, I know I'm saying it over and over again, but you must take it within the market memory. By the way, the time frames that I keep an eye on are the 15, the 30, the 60, the 4-hour, and the daily. Those are the time frames that I watch for the pairs that I trade. Let me give you the market memory, and let's just kind of move over to the 15-minute chart. The 15-minute chart market memory is 3 to 5 days. Okay? 3 to 5 days. Real simple. You want to take your assessment of the angle of the wave. You want to take your assessment of the current and past trends, notable highs and lows. If you're going to draw trend lines, do it from within this 3 to 5 day look for the 15-minute chart. If you're looking for Fibonacci or things like that, again, most of my charting analysis is done within the market look back, that market memory. Once I've done all that, then I'm free to expand out of it and do whatever I want to my view. But my analysis must be done in the look back. The 30-minute we talked about, 1 to 2 weeks. The 1-hour chart is 2 weeks. Now remember, I absolutely know that there will be times when you cannot get exactly 2 weeks or 3 days or whatever the market memory is for a particular time frame. Try to get as close as you can. Okay? If you're going to be a little bit over or under, I'd rather you be a little bit over. So if the market memory on a 60-minute chart for your view keeps sliding closer to 3 weeks, I'd rather you have 3 weeks than, for example, 10 days for a 2-week look back. Okay, so I'd rather you be a little over. But please, don't think more is better. Get as close as you can, and if close as you can means a little bit over, that's fine. So, one hour chart, 60-minute charts is 2 weeks. The 4-hour chart is 4 to 6 weeks. So you need about a month to a month and a half. And finally, the daily chart is 52 weeks or 1 year. Okay, so you want to squeeze in basically 1 year of look back. Now again, you might not be able to get exactly that 1 year. And on the daily chart, it can be super tricky So it's basically 6 months to 1 year. If you end up with something that's closer to 10 months, I understand, that's fine. At some point, though, take a look at the 52-week high and low. Okay, at some point, even if, like, for example, when I squeeze in the 1 year, I get actually closer to a year and a half. Okay, but make sure you know where the 1 year or the 52-week high and low was, because that's very important support and resistance for a daily chart, for an end of day or daily chart. So there are the look backs to the time frames that I trade, that I most commonly trade. So you know what the wave is, you know how to take the reading of an uptrend and a downtrend. What about